All right, ISHR students, welcome to another video lecture. Our last lecture was on fiscal policy. Today we have a video lecture on monetary policy. This lecture will sort of act as a substitute for your textbook, or it can kind of act as a supplement. You can use it with your textbook. Anyway, so let's get to it. Before we get really started, I want to draw your attention to the two buildings and the two individuals on this front page. We're going to, refer back to them in a moment. So again, just kind of drawing attention to them. Okay, before we get started, I think it's important to understand and identify our learning goals. What do we need to know? What do we want to learn? Firstly, we need to define monetary policy and explain the roles and tools of the central bank. So we're going to define it and we're going to know how it operates. Secondly, we need to understand how interest rates impact aggregate demand and how you would create a diagram. Thirdly, our third learning goal is that hopefully by the end of this you can explain, using diagrams, how contractionary or expansionary monetary policy works. Another kind of interesting but seldom talked about IB standard, something that we also want to learn, is how the importance of the AS curve, how the shape of it plays a role in how we perceive monetary policy. And we'll talk about another seldom talked about topic, but it's also important, is inflation targeting. Why inflation targeting, why central banks do it, and what might some other goals be of central banks. And finally, we will evaluate monetary policy. So anyways, hopefully by the end of the lecture, you'll be able to do these things, or you'll at least have some idea about these things. So again, these are our learning goals. Okay, let's get right to it. Central banks. Monetary policy is usually set by the central bank. This is an entity that exists in most countries that is separate from the government. It's technically a part of it, but it is not elected. It's not. People that run the central bank aren't voted in by you and I or regular citizens. So it is kind of technically a part of the government, but it's also not. And so basically it's the central bank, the main bank of a country. Anyway, so let's define monetary policy, which is set by the central bank. And it is defined again as its policy set by the central bank that uses interest rates, reserve ratios, and open market operations to impact the supply of money and ultimately AD. And so this is how we want to define monetary policy. Next, the picture on the front page that we were kind of drawing your attention to, those are the two largest central banks in the world, and those are the two chairmen of those central banks. The Fed and the ECB. I wonder if you know what these stand for. The Fed is the Federal Reserve and is the Central Bank of the United States. ECB is the European Central Bank. And the two chairmen that you saw there were Mario Draghi of the ECB and Janet Yellen of the Fed. And just to kind of give you put a face to the name, just thought you would want to know that. So just kind of letting you know about those two real-world examples. Anyway, as we said, we're going to define monetary policy, which we've done. Now we're going to talk about how a central bank works and what are its roles and responsibilities. And one of its main roles and kind of responsibilities is it regulates commercial banks and banks that lend to government. So the central bank sort of sets rules that impact all the commercial banks. Commercial banks are just banks kind of down the street from you and I, banks where we save our money, where businesses get loans. Banks like Commerzbank, Deutsche Bank, the Royal Bank of Scotland, U.S. Bank. These are all commercial banks, banks where businesses and consumers do business, save money, lend money. Okay, let's talk about, that's one of the responsibilities, and we'll go on, get into that in the next slide. But before we do that, in our definition, we talked about three things. And these are terms that you need to define. They're actually in your homework, so you hopefully want to define these. But first term in the definition was interest rates. And interest rates are the fee, or interest rate is the fee paid for borrowing money. It's usually expressed as a percentage, and it's based on the principal. The principal is when you take a loan. The principal is the initial amount borrowed. So if you borrow 10,000 euros, that is the principal. The interest rate would be a percentage of that you would have to pay as a fee for a certain amount of time until you pay back that money. So again, the definition of interest rate is just the fee paid for borrowing money. That would be fine. All right. And next we have reserve ratio. What does reserve ratio refer to? Well, as you probably can see on the slide, banks are required to keep a certain amount of their depositors' funds. So, when you save and I save and businesses save their earnings in a bank, banks are required to keep a percentage of those deposits in cash on hand. They cannot just lend everything out, because as you know, when you save money in a bank, the bank doesn't just let that money sit there. They lend it out for investment purposes. People that want to buy homes, the bank lends them money. Businesses that want to buy new equipment, the bank lends them money in order to make money to, be profitable. So central government sent that reserve ratio, or sometimes called a reserve requirement, that sort of says the percentage of deposits that the banks are required to keep on hand. Finally, open market operations, buying and selling of bonds. The central bank will do this as well. So these are the three tools of the central bank. These are the three things that the central bank can kind of manipulate along with the money supply to impact ultimately aggregate demand. So those are the three tools. When we talk about, we said we wanted to learn the tools, so those are the three tools, and then we also wanted to talk about the roles and responsibility. As we said, they regulate commercial banks. How do they regulate commercial banks? Well, firstly, they set the discount rate. Your commercial bank, the bank down the street from you, when they need money to lend out to their customers, or their clients rather, your commercial bank will borrow money from the central bank. And the money that it borrows from the central bank, it's also charged an interest rate. It's an interest rate set by the central bank, and it's called the discount rate. So when the central bank sends the discount rate, or the interest rate that is charged to commercial banks, your commercial bank will base its interest rate off of that discount rate. And we call it a discount rate because it's a lower rate than what we would pay. The commercial banks get a discount, obviously, or the rate is discounted because, if you think about it, the commercial bank is always going to charge you or I a higher rate of interest in order to make money. So anyway, they set the discount rate that is charged to commercial banks. They set the supply of money, which in a way also affects the interest rates, and we're going to talk about that in a minute. They set the reserve requirements, so how much commercial banks are allowed to lend out. And this, changed, kind of an interesting historical example. After the Great Depression, or during the Great Depression, there was a big run on banks. Everybody went to banks and wanted to get their money out. And the banks didn't have the cash on hand. And so, reserve requirements definitely changed and were implemented after the crash of 1929. And finally, central banks do have a role in sort of regulating lending and investing practices. And, obviously, when you take out a loan, hopefully you have the means to pay it back. And so the central bank plays a role in that. All right, let's talk about how the central bank impacts interest rates through the money supply. The central bank is kind of in charge or has a direct link to, printing money. And if they were to print a lot of money, right, if there was a lot of money in circulation, that means there's a lot of money circulating in the economy. What do you think would happen to interest rates? Just think about that for a second. What happens to interest rates when there's a lot of money in an economy? Well, if there's a lot of something, it's abundant, it's less scarce, therefore, the value is probably lower. So not only do we have inflation because there's a lot of money, so the relative buying power of that money is lower, but also because we have a lot of money flowing in circulating that economy, it's easier to borrow it. And when it's easy to borrow, the interest rate will be lower. So if there's a lot of money, it tends to be that interest rates are low. Whereas if there's not so much money in circulation, kind of the opposite, when there's not a lot of money, what happens there? Well, it's kind of the opposite, right? When there's not a lot of money, it's not as abundant, it's more scarce. The money that can be lent would then be, more expensive in terms of interest rates because there's not as much of it. And so the central bank will either increase printing or decrease printing, which ultimately impacts interest rates. They also set the interest rate, the discount rate, so they impact it two ways. So let's look at a diagram for this. This is called the money market, or the market for money. On our y-axis, we have the rate of interest, or interest rates, and on the x-axis, we have quantity of money, or money. And usually, SM stands for the supply of money, and basically it is a fixed amount, and so it is a perfectly inelastic curve, right? There's just a given quantity of money. So again, the supply of money is just a perfectly vertical curve. And then we have a demand for money, and that is downward sloping. If you think about it, as the interest rate is lower, the quantity of money demanded will be higher. Why is that? Well, if interest rates are low, people want to borrow money to buy houses and cars, whereas if they're high, they don't. So anyways, the supply of money helps establish the interest rate based on how much money is circulating in the economy. What the central bank might do is, they might increase the supply of money. And when you write it, when you make this diagram or you are explaining this diagram, you could kind of say it two ways. You could say, one, the central bank increases the supply of money, or you could say they lower interest rates. Typically they increase the supply of money, which results in lower interest rates, but at the same time, the central bank, you have to realize, is also lowering the discount rate. So they're kind of doing both simultaneously, but you would say the central bank increases the supply of money, which results in a lower rate of interest, and that increases the demand, or the quantity demanded rather, for money. Also, they could decrease the money circulating in the economy. That would raise the rate of interest. So this is kind of what the central bank, this is sort of the money for market and how the central bank impacts the market for money. They can increase the money supply or decrease the money supply, raise and lower interest rates. And if you think about it too, if they were to lower interest rates, which a lot of banks, they will go out, or central banks will go out and just say, we're lowering interest rates to kind of motivate spending, then banks will in turn adjust their rate of interest, and more people will be demanding money for loans, and businesses will be demanding money for loans as well. Okay, so basically just the, important thing to know is that the supply of money influences interest rates and ultimately consumption and investment. When interest rates are low, people want to buy more houses and cars and buy more things on credit. Businesses will take out more loans basically there'll be more investment spending on capital goods because businesses can borrow money easily to buy better equipment and technology. And so, this is just kind of how the supply of money and interest rates sort of impact consumption and investment. You could even show it in a diagram too. We could take that same, very similar diagram, but with just a demand curve to show the market for investment, and we have the interest rate and the quantity of investment. And kind of as we saw in the previous slide, when they increase the money supply and interest rates go down, if you think about it, what's going to happen to the quantity of investment? Well, when interest rates are low, there's going to be an increased quantity of investment. Firms will, want to lend more money to spend on capital goods, and also consumers in an economy, when faced with the decision of whether to save in their savings account or to invest in the stock market or maybe buy bonds or mutual funds or whatever it is, they'll be more encouraged to invest, which provides the funding necessary for firms to improve those capital goods. So low interest rates increases the quantity of investment. Anyway, so when we were just talking about when the central bank increases the money supply or lowers interest rates, this is what's known as expansionary monetary policy. If we have a low interest rate due to a really large supply of money, consumers are encouraged to spend. And as we saw in the previous slide, there's increased levels of investment. And so AD shifts to the right, and we have a little bit of inflation and a little bit of economic growth. So you can kind of see how the central bank, by setting a low interest rate and increasing the supply of money, will stimulate aggregate demand and hopefully promote some economic growth. This is called expansionary policy. And that's one way they can encourage AD to shift to the right. They can also, they have other tools, as we said. So they can, increase the supply of money and lower the interest rate. They can also buy or sell government bonds. And when they, for example, if the central bank buys government bonds, which we're going to talk about in a moment, if you think about it, if a business or a person has a bond and the central bank has money, when they buy the bond from the bondholder, money goes from the central bank to either the business or the individual in an economy, so basically increasing the supply of money. And when we increase the supply of money, as we saw, the interest rate goes down. Also, they can change the reserve requirement. If you tell banks, for example, you don't need to keep as much cash on hand, you can lend more of it out, what will happen to the money supply? Well, the supply of money will increase and hopefully interest rates will go down. So again, these are the kind of the three tools, and if we lower interest rates, buy government bonds, or lower the reserve requirement, this will stimulate the supply of money, and then it will ultimately lead to an increase in aggregate demand. If we do the opposite of those things, that if we increase interest rates, there'll be less lending and a lower supply of, a lower demand, a quantity of demand of money. We could also sell government bonds, which takes money out of the economy, or we could increase the reserve requirement, which would also decrease the money supply, and ultimately have the opposite impact on AD. So if you wanted, you could use all three of these diagrams together. You could basically say that the central bank increases the supply of money and lowers interest rates, which is represented on diagram 1 in the top left corner. which will increase the quantity of investment. And ultimately, both of these things, so diagram 1 and 2, will lead to an expansion of AD, or an increase in AD, and this is known as expansionary monetary policy. Why don't you take a moment and write down this diagram? And, so this is expansionary. Contractionary is just the opposite. It's when we go from the opposite way, when we increase interest rates and decrease the supply of money. Instead of moving in diagram 1 from A to B, we would move from B to A. In diagram 2, we would move from B to A, and then AD would shift back. We use contractionary monetary policy maybe to curb inflation. If it gets too high, we use expansionary monetary policy to promote economic growth. Anyway, so let's just do a quick review. Let's see if you've learned something. Can you define monetary policy? Can you define it? One, and I hope you probably said, it is a policy set by the central bank that uses interest rates, reserve requirements, and open market operations to impact the supply of money and ultimately aggregate demand. Next, what are the tools of the central bank? Well, it's kind of in the definition. Reserve requirement, interest rates, supply of money, and finally, open market operations. So how might the central bank, final question, how might they implement expansionary monetary policy? How would a central bank do that if they wanted to promote economic growth or a little bit of inflation? Well, what would they do? If you said, you can pause the video for a second and think about it, but if you said they would lower interest rates, or they would lower reserve requirements, or they would buy bonds, any of these things would increase the money supply and ultimately stimulate aggregate demand, and that's kind of how they implement expansionary policy. Okay, so this is the first of 2 videos. I hope this answers some of your questions, and anyway, the second video will just pick up where this one left off.